Hello, and welcome to the Business Academy. Today we'll be discussing common practices when migrating accounting into business. Today's session will assume a full accounting migration and demonstrate how to migrate from one system into business. Now let's take a minute to discuss what a full migration means and its relation to today's lesson. A full accounting migration indicates that the company bringing over their accounting is also bringing over their ledger balances, accounts receivable and accounts payable totals, inventory numbers, and open sales tax payables. Before we begin any further, I would also like to mention that today's lesson is specifically geared towards migrating accounting, but there's a lot of setup that needs to occur before this should be completed. Things like customers, vendors, chart of accounts, items, and sales taxes should all be set up in business prior to making this final step in terms of migrating your information from one system into business. I will be touching on how to import all of these functions and also how to enter them into the system. But for more detail on how to set up any of the things that I've previously mentioned, including customers, vendors, items, chart of accounts, I would also recommend attending our introductory courses on employees, customers, vendors, our second accounting, Let's Begin, and these will all show you how to import these and how everything in terms of setup works in more detail. Now, as previously stated, today we'll be simulating a full accounting migration so that no stone is left unturned. Topics that will be covered today include information needed per migration step, how to prepare imports, and setting a closing date in business. So with that, I'd like to jump into the lists we've received from our contact and what these should include. Since we're simulating a full accounting migration, we need a total of 5 lists or reports from our company's other system. These include the following: a balance sheet, AR aging detail, AP aging detail, an inventory evaluation, and a sales tax payable report. So now that we have all 5 reports, let's examine them and run through what each report represents and some things to watch out for before making the jump to migrate accounting. So first, let's look at the balance sheet. So the first step in the balance sheet is making sure that everything is balanced correctly. This means that the assets equal the total liabilities and equities. Now to do this, we'll scroll down and we'll see the total assets right here equate to $876,736.79. Now, as I scroll down to the total liabilities and equities, we should see this exact same number, which you can see here. The total liabilities and equities are equaling perfectly to the total assets. Now, if these two totals are not equaling out, that means the balance sheet is unbalanced, and we highly recommend that this gets resolved before migrating accounting into business so that everything is accurate in your books. Now, the next step in terms of what we've received, let's go to the AR aging. So the AR aging reports lists all of the open invoices that are due to your customers. The amounts that are due are separated by their payment terms. And on the far right, we have the total balance of what was owed as well as the open balance. And as we scroll down, we'll have the totals down here. And the amount that we're going to migrate into accounting that is going to total up is the open balance total of the AR. So that is $40,281.52. Now, the key in looking at your AR aging detail is that the total open balance should equal the total AR on your balance sheet. So with that, let's jump back to the balance sheet. And let's remember that number, $40,281.52. So as we scroll up, we have $40,281.52. So everything is equaling out perfectly, not only in the assets and liabilities, but also our accounts receivable is equaling out as well. Now, as we go to the AP aging report, this shows what we owe our vendors, and these are open bills that we have to pay. Now, just like the AR aging, these are separated by their payment terms, and on the far right, we have the total balance and the total balance that is open. And this $26,602.67 should be on our balance sheet underneath the liability section, and that should equate to the total accounts payable. So as we jump back to the balance sheet, we have the accounts payable that is $26,602.67, equaling out perfectly to what we have on our AP aging report. Now our fourth report, our inventory valuation report, lists all of the items and their costing. Now this shows exactly the quantity on hand, the location that all the inventory items are located, as well as the unit cost for each. Our sales tax payables are listed here, and this will list all of our taxes that we owe. So there's a lot of checks and balances that need to happen in terms of all the reports that you've received, making sure that everything is balancing correctly and that everything's equaling as it should. Now, in each report, I'd like to go back to the inventory evaluation report. There shouldn't be any negative quantities within this report. If there are negative quantities, they should be checked for accuracy so that no negative quantities will be added into business. And if they are negative, maybe it should be a positive or a 0 or something like that. But everything that is brought into business should be a positive quantity. So now that we have all of our 5 lists, I'd next like to discuss the balance sheet in a little more detail in terms of how this is brought into business. Now you may notice that all of those other reports that we have, the AR aging, the AP aging, the inventory evaluation, and the sales tax payables, all of their GL accounts are highlighted in this report, and that's for a specific reason. Now anything that is not highlighted is going to be brought into business via a journal entry. Everything that is highlighted in yellow is going to be brought in by other means. So those other means are other things that we're going to be talking today, which each are different steps and different functions in terms of bringing over those quantities, values, and totals into business. So now that we've discussed that, I'd like to jump into business to discuss all of these steps in a little bit further detail. So now that I'm into business, first let's go over our AR aging. So to bring over our AR aging, we're going to enter all the invoices that are on that AR aging report. And we can either do that by entering them manually, or we can import them into business. Now if we go back to the AR aging report, we'll see all these invoices have invoice numbers, dates, and the payment terms for which they're owed. And all that information can be entered either on an import sheet or on the individual invoices themselves. To find the import sheet to import your invoices, we can go to Accounting and Transactions. Once on the transaction screen, we can go to the Import button, and as we click, we'll have 3 options, and one of them is Invoices. As I click Invoices, we'll be brought to the Invoice Import screen, and here we'll be able to show more information in terms of how to import all this information. So first we have our Select button, which we can select from our PC for a list of available sheets. We also have a window icon, and this will represent the mapping for the CSV file. We can also download a sample CSV file with this Cloud button. This will show column headers and all the information that needs to be filled out down below those headers. Now to show that in more detail in terms of what's needed, we can click on the Window button, otherwise known as the mapping. And this will show us all those headers, as well as the data type, whether it's alphanumeric, meaning that it's letters and numbers, a date field, a yes or no field, and so forth. We can also see the description on the far right to know exactly what type of information needs to go underneath each column for each invoice. Now to fill out that CSV file, we'll just fill out all the information received from our AR aging report underneath its correct columns, and then we can import that in by selecting the import file. Now to simulate all the information inside of an invoice, I'd like to go ahead and start entering a brand new invoice to show you what it looks like in business. So here I can go to the plus sign in invoice, So this is an invoice in business, and essentially the information that we're going to import on the invoice is the invoice number. So we can enter this from the old system. This could be any number that we have within that AR aging, the date that it was owed, and we can change that to whatever date we have on the spreadsheet. So for instance, if I do this invoice number 6, this was started in 8/28, so I can enter that date. The payment terms are net 10, so I can adjust that here. The amount was $1,407, and the invoice was number 6. Now the customer we can select from our list down below. Now as I scroll down, we have our items list, and this is essentially the topics that I want to discuss in further detail on the invoice itself. Now this will also have to be entered on the import spreadsheet, but I want to talk about it on the invoice itself because it gives a little bit more clarity in terms of why we're choosing this particular item. Now the item we're going to choose when we're importing is called the opening balance equity item. The quantity is always going to be 1. The unit price is how much we owe for that specific invoice. This is the invoice total, which is $1,407. So now we have our total invoice amount, we have our quantity of 1, we have the date, the payment terms, the invoice number, and the customer information, and we have our item, which is opening balance equity item. Now, in terms of why we're choosing the open balance equity item is because we're importing or entering, in this case, an invoice. Invoices are going to debit accounts receivable. That means it's going to increase the amount of accounts receivable on our chart of accounts. But because this is a double entry accounting system, we have to then credit another account. We're choosing the opening balance equity item to credit our opening balance equity. And we can demonstrate this. Let me just choose a GL category since I'm requiring that information in my business system. I'll click Save by viewing the posting journal. Now, as soon as an invoice is saved, we have a lot of tabs up top, but one of them is posting. So if I click the posting journal, we'll see that we're debiting our accounts receivable, therefore increasing the total, and we're crediting our opening balance equity, increasing its total as well. So that's the reason why we're choosing our opening balance equity item. Our opening balance equity account is going to be affected because this is adding to our opening balance in business. Our accounts receivable is going to be increased because it's money that we are being owed from our customers. And therefore, everything is working as it should in terms of the migration. So on that invoice import sheet, you're going to fill out all the column headers. Your item is always going to be opening balance equity item for an invoice import upon migration. Your quantity is going to be 1. The unit price is going to be the invoice total. And the dates should follow as needed. Now, all that is received from our AR aging, so the import spreadsheet will just follow down below. But it's very important that your item should be that opening balance equity item, your quantity should be 1, and your unit price should be the invoice total. Now, moving on to our AP aging. To demonstrate how our AP aging works, I'll open another bill. Now, to open a bill, we can go to Vendors and Create Bill. This will open a blank bill for a vendor that we have. So here, if I go to our AP aging, we can see all of the bills here. Let's just take this Apple bill here since it's the only one for this particular vendor, and we'll start working with all that information. Now, a bill is what we owe our vendors. So here, if I just choose Apple, We'll choose that particular vendor. Now the date again is going to be entered over here. So that date is 8/15. The payment terms are net 30. Now down below, we have an items column. And now the same exact item is going to be entered for our bills. So that's going to be the opening balance equity item for bills as well. The quantity again is going to be 1, and the unit price is going to be the bill total, which is $8,000. Now again, I'll choose a GL category since I'm requiring that information in my business system. But essentially all that information has just been entered that we need to migrate that particular bill into our new business system. We have our date, our payment terms, our vendor, our item, which is opening balance equity item, our quantity of 1, and our total bill cost. Now again, if I click save, we'll be able to save the bill and also view our posting journal to make sure everything is affecting correctly. Now, because this is a bill, it's going to credit, therefore increasing our accounts payable, and we're going to debit, therefore decreasing our opening balance equity. Now, the third report that we have is the inventory valuation report. And this we can do in business by performing what we call an inventory adjustment. We can view that in business by clicking accounting, and we have an inventory section here, and you'll see the second option down is adjustments. Now as I click on adjustments, we can see a list of adjustments by clicking search, or I can click add to add a brand new inventory adjustment. Now inventory adjustments are made to increase your numbers that you have on hand, and you can also increase the value or cost of the items that you have on hand as well. And you can either do that one at a time, or you can affect the quantity and cost or value at the same time. And you can change those inventory adjustment options by choosing the quantity hyperlink in blue. And this will drop down 3 separate options for inventory adjustment types. The quantity will change the quantity of the item. The value will change the value of the item, and the quantity and value will affect both at the same time. Now for our purposes today, I'm going to choose the quantity and value to demonstrate how each would be selected within our business system. Now when you choose an item for the inventory adjustment, again, we'll go back to our inventory valuation sheet. Let's take the first item right at the top, this Nest camera. So we have 120 of these items on hand. They're in the warehouse location, and the unit cost is $56.90, which is exactly the information we're going to use in our inventory adjustment. Now, before I start entering that information in, I would like to note that we have an import for adjustments as well, right here, and we can choose the blue button to effectively bring up the inventory adjustment import. Now, these lines over here will let us show the mapping. These are the column headers in the CSV file, the data type, whether it's alphanumeric, currency, and so forth. And we also have a description to note exactly what information goes underneath each column header. And we can download a sample CSV by clicking the cloud icon, and we can view all the column headers as well. Now to demonstrate what this looks like in business, we'll just choose our item. So this was the Nest camera. So now as we choose our inventory item, our inventory locations drop down below. Now if we go back to our inventory valuation sheet, we can see this is in the warehouse. So over to warehouse, we're going to enter in the quantity adjustment total 120. This will increase our new quantity to 120. And then the unit value will be the total cost. So if you go over here, $56.90. And that's entered in the unit value up here. And our category, if we're tracking our GL categories, can be entered up here as well. Now, if you had multiple locations, you could enter in your different quantities in each location as needed. Since we only have one location, I'll keep all these at 0 and only have our 120 in the warehouse, as that's what appears on our inventory valuation sheet. So that is going to not only increase the amount that we have on hand from 0 to 120, but it's also going to affect the cost of that particular item. As we see on the right, there's no cost to that item currently. So it's going to increase the cost from 0 to $56.90. And it's also, because we're effectively bringing them 120, it's going to increase our inventory asset account total. And as we bring in all of these items, we should hit the exact inventory asset total that's on our balance sheet, which is $70,596.25. Now, it's very important when doing an inventory adjustment that the quantity you're adjusting goes in this column here to the right. It's very important not to put quantities that you're adjusting in the new quantity column. The new quantity column is going to be a preview for what's going to be affected. To simulate what I mean with this, let's choose a different item. So let's say we have this Chromebook. We have 4 on hand currently. To simulate what each one of these does, let's put the new quantity at 2. Because our new quantity is at 2, this quantity adjustment is going to be a -2. Because to get to 2, we have to subtract 2 from 4 to get our new quantity of 2. So instead of increasing 2, now we're decreasing because we put the +2 in the wrong column. Now, if I put the quantity over here at 2, you'll note that the new quantity over here goes to 6 because we've effectively increased our totals from 4 to 6. So it's very important, if you do have quantities on hand, that the new quantity that you're adjusting goes into the quantity adjustment. This will effectively display a preview in the new quantity that will either add or subtract from the quantity on hand. So now if I save that inventory adjustment, we can also look at the posting journal to see what's going on with this particular transaction. And here we can see that all of our inventory asset accounts have been effectively increased. You can see the amount that it's debiting. And because, again, we're choosing that opening balance equity account on the account with the inventory adjustment up here, we're also crediting the opening balance equity item. Now, you may be asking, why are there multiple different line items for the same camera? This is effectively showing you different inventory locations and how much they're being affected. Since we don't have any items that we're increasing in either the warehouse receiving area or the showroom, those are both at $0, but still appear on the report to show anything that has changed with those inventory locations per item. Now, the fourth report that we've received is the sales tax payables report. And you'll see that we don't have a lot of information on this report. And you'll see the total sales dollars is $5,132.34. The taxable sales is that amount. The tax collected is $307.94. And as of the cutover date, which is September 10th, 2018, this is how much we owe to our vendor of Pennsylvania. Now, to bring that information into business, we'll perform what we call a sales tax adjustment. Now, to find that within business, we can go underneath the accounting tab, and you'll see a sales tax section here, and you'll see the adjust option is the second one down, and this will bring over our sales tax adjustment. Now, to adjust our sales taxes, we need to know a bit of information. Now, some of this is pre-migration information, such as the sales tax agency and the sales tax itself. Now, that can all be set up in business. This is something that we go over in our other Business Academy webinar, called Accounting Let's Begin, and I recommend attending that or viewing that webinar to see all the information and setting up your sales taxes. Now, the sales tax adjustment will need a sales tax agency, and this is the vendor who you owe the money to. So here we can choose the Pennsylvania Department of Revenue as who we're going to pay the sales taxes to over a given period of time. The sales tax is the tax rate that we owe the sales taxes for. So I can choose PA as the Pennsylvania state tax. Now, again, because I'm choosing to track GL categories and I'm making that required, I'll have to select GL category from my list. The transaction date we want to have be the cutover date. So this is today's date, so we don't have to change that. If we did have to change it, we could choose the calendar option over here. Now, the adjustment account is what account is being affected by this inventory adjustment. Now, if I search for PA tax, we'll see our PA taxes payable, which if we go to our balance sheet, is the same GL account that we're going to be migrating into. Our adjustment account is what we owe. So if we go to the sales tax payable report, $307.94. Now, effectively, we'll just click Save and Close to change that, to effectively issue this sales tax adjustment. Now, you can do a negative quantity as well. So if you wanted this to be a negative 307.94, you do a negative, and the parentheses will notate a negative number. If it is a positive, we'll just subtract the minus amount. It'll go to the positive $307.94. As we click Save and Close, this pop-up will go away. Now to view that sales tax adjustment, we can go into Accounting and Sales Tax Pay. This will show exactly what we owe on sales taxes. To view the actual sales tax adjustment, we can go to our transactions. Now, when you do a sales tax adjustment, essentially what's happening is that this is a journal entry. You're going to debit and credit two accounts, one of which is the account that you've affected on your sales tax adjustment, which was the PA taxes payable. The other is set up in the system, which again is talked about in Accounting Let's Begin, our other Business Academy session on setting up your accounting system. To quickly run through where that's located, we can go to Company and Settings. I'll open this in a new tab. Underneath Accounting, we have Sales Taxes. And if I click Setup, this is the other account that's going to be affected, and it's set up in your settings here. So what's going to happen on that journal entry itself is that the PA taxes payable is going to be affected because that's what you've chosen to affect on the sales tax adjustment. And taxes paid is also going to be affected since this is your sales tax GL account that you've chosen in the settings. Now, if we go into the transactions, I can uncheck all and only check journal entries. And this will allow me to effectively search for only journal entries in my system. Anything with sales tax adjustment will be noted as sales tax adjustment. And we can see this was entered today. So this is our sales tax adjustment for 9/10. And you'll see that we have credited the taxes paid account, and we're debiting the PA tax payable account. Now, the last bit of information that is brought into business is the balance sheet. To bring over all these values of your GL accounts into business, we'll do a journal entry. Now, if I go back to the transaction screen, if I choose import, we do have a journal entry import, which I can open. And just like the other imports, we can select from our PC. We can view mapping by hitting the window icon. This will show our column headers, our data types, and our descriptions are on the far right. Now, when you're importing your journal entries, it's important to keep into account what you're debiting and what you're crediting. And at the end of the journal entry, everything should be equaling out. Your debits should equal your credits, and everything should be equaling what's on your balance sheet before you import. If debits and credits are not equal, business will warn you of that effect, and you can effectively change your outcomes. Now, again, we can also download a sample CSV by clicking the Cloud button. This will allow us to enter all our information below the column headers. Now, to demonstrate what this looks like in business, we'll go to Accounting and Journal Entries, and I'll just click Add Journal Entries up here. And this will bring up a brand new journal entry. Now, the transaction date we'll keep as 9/10 since that's our cutover date. Again, if we did have to change that, we can click the calendar option and choose from a date in the calendar. Our memo, we can choose to write in accounting migration so that we know exactly what this is being made for. And underneath the accounts is how you're going to choose the accounts you're going to bring over into business. Now, if you're not importing, you choose to enter these manually. There's really no right or wrong way. It's just a matter of how you'd like to do that yourself. But if you're going to enter them manually, you can simply choose which bank accounts you're going to enter. So for instance, if I choose my PNC Bank, I'll enter that. And this is a positive number, which means it's going to be on the debit side, and that's $12,048. Now you'll notice that as I enter that on the debit side, we have a blue hyperlink in parentheses on the credit side for that exact same amount. And this notates the difference between either the debits or the credits, and it appears on the side where the amount is differentiated. Now, as I choose a different account, let's go to the liabilities side. Let's enter this loan payable. Now, again, this is purely a demonstration. Effectively, if you're going to enter a journal entry, I would highly recommend you go line by line, skipping, again, the accounts receivable total, the inventory asset total, the accounts payable total, and the PEA taxes payable or any tax liability account that you owe, because those will be brought in with the previous methods that I mentioned in this demonstration. But just for our simulation purposes today, let's effectively enter this MasterCard. So I'll choose MasterCard, and we'll enter the amount that we owe. Now, since this is a liability account, we're going to credit the account to increase its total. And I'll just copy and paste this into the credit section. And you'll note that now, because we've entered an amount on the credit side, that amount that we owe or is off balance on the credit side has decreased effectively. Now, as you enter things down, you should notice that blue hyperlink at the very end. And this means that you'll have to effectively note the opening balance equity account to offset the amount that you owe. Now, if I choose opening balance equity account, all we'll do with that remaining total is just click it, and it drops down to that last line item, which should be the opening balance equity account, therefore balancing out exactly what you owe on the journal entry and making sure that your debits equal your amount of credits. Now, when all that is finished, you've entered your journal entry, your AR aging is in via the invoice import, all your bills are entered, you've done your inventory valuation via your inventory adjustments, your sales tax payables are in via the sales tax adjustment entries. You're then ready to finalize or ensure its accuracy. Now, to ensure your system's accuracy, we can go to reports, and you're going to want to view your balance sheet. Now, when you view your balance sheet, you're going to want to go through and make sure that everything equates the way it does on your balance sheet report, that your total assets equal your total liabilities, and that everything is looking as it should. Now, after looking at your balance sheet and you see that not only is it balanced, but also that all your separate GL accounts equal what you have on your balance sheet, you're then ready to confirm that everything's set and set your closing date in business to protect all that information. Now, to set a closing date in business, we'll go to Company and Settings. And to find that closing date option, we'll click the Accounting option in the Settings and go to Settings underneath Accounting. And this will bring up a lot of options that we have, but on the top right, you'll see the closing date. Now, to change your closing date, you're going to click the Calendar option and choose the date in which you're closing your accounts for the year. So this is September 10th, 2018. So then you set your closing date. We'll go down here and click Save. By saving your closing date, it protects all that information from anybody who does not have access to change that information once it's set. So that's all detailed by permissions within business. And if you'd like to view that permission, we can go into Employees and Manage User Access. Now, Manage User Access shows anything, any permission that is in business that you can effectively assign to any user role. But for instance, if I go to the function name, I'll just search closing and choose search. We'll see transactions prior to closing date -edit. This will either enable or disable any user from changing transactions before the closing date. So as long as users do not have this particular permission, they will not be able to edit any transaction that is made prior to the closing date, therefore protecting all your accounting migration data. Now, if you'd like to see who has that particular permission, you can choose View Access, and this will list all of the employees that have that permission currently. If you'd like to manage the user roles that have that, you can choose Manage Access, and this will list out the user roles, and you can effectively delete any user role that has that permission to unassign the permission to that particular user role. So after you set the closing date, it is worth looking into the transactions prior to closing date -edit permission to make sure that people can't adjust that information who shouldn't be adjusting that. So with that, I'd like to end our Business Academy session for today. I hope all this information has helped clarify some things in terms of migrating particular totals into business from your previous system. Again, today was a simulation of a full accounting migration. Some of these you may not need to migrate in terms of accounting, but we did this option to leave no stone unturned and ensure that all that information is out there for your needs. I'd like to open about 5 to 10 minutes for any questions that anybody may have. If you don't have any questions, please feel free to leave our Business Academy session. And again, thank you for not only registering but attending our Business Academy session today. We hope to see you next time on the Business Academy.